Hey guys, this is Karthika Kantwal from Apex Finserve, and I'm back with the second series, or the second part of the Wyckoff series. Wherein, if you remember last week, if you saw that video, we had a brief introduction of the Wyckoff structure analysis. What is it? How we go around doing it, and what do we hope to accomplish from it. And we discussed a couple of basic important things and terms such as the three laws that govern and the phases, the basic of the phases. And I told you guys that this week we'll be going into the depths or a bit in depth of what defines the structure, the accumulation, markup, markdown, distribution that we had. If you can see on the chart, just to take you through the basics once again, we discussed the three laws that were the law of supply and demand, the law of cause and effect, and the law of effort versus resistance. All three of which I explained to you guys, as simply as I could. So I hope you guys understood that. If you did not, then feel free to ask the questions to me, because we'll be going into the slight technical terminologies today. For example, as you can see on the screen, you have this basic graphical explanation of cause, effect, and accumulation, markup, distribution, markdown. But how do we identify the accumulation, and what are the steps that go on to determine how strong the movement is going to be? That is what we are going to be checking in today. Now, the thing is, no matter how simple I try to put it, it is important, and it is key that you are able to understand and identify the terminal points and the terminologies that we'll be using as reference in this video. So if you have a pen and paper, if you have something that you can note it down on some keywords, then I would recommend that you keep that with you, you keep it handy, because that is surely going to help you understand this a lot more quicker. And don't worry if you don't understand it all at once. You can take your time, you can watch it multiple times. There is no there's no problem with that. So, keeping these things in mind, starting with the Wyckoff structure analysis, we'll be discussing two schematics, accumulation, distribution today. What are the key factors of accumulation, distribution, different phases, and how do we justify these things. Now, the thing about Wyckoff is basically it is meant to be a strong trend friendly method or strong trend friendly approach to trade. If you remember the composite man theory that we discussed last time, so that clearly stated that what we are trying to do here is we are trying to catch the movement or the breakouts that the composite man is planning, or that the operators are driving the direction, or we are trying to enter a trade in that very direction, keeping in mind that it is being driven by the operators, and that is exactly where we want to align ourselves. So that is exactly what the Wyckoff theory tries to accomplish. We have trading ranges known as the accumulation and distribution, and the break of this range is exactly what we are trying to catch. So, defining it in terms of Wyckoff, trading ranges are places where the previous trend has been halted and there is relative equilibrium or range bound market between supply and demand, where all the big players, institutions, and biggies, they are preparing either for the next bull run or the next fallout. In both accumulation and distribution, the composite man is actively buying and selling, influencing the price to develop new trends. Now, that is essentially nothing but the definition of what is actually going on in the accumulation and the distribution phases. Now, coming to the schematics, now this is the accumulation schematic, which has five phases: phase A, B, C, D, and E. Now, don't worry if this looks a bit, scary, to be honest, because you have a lot of terms. You have PS or preliminary support, you have SC selling climax, automatic rally, secondary test, LPS lowest point of support, and a lot of other things, sign of strength. Now, the thing about this is, first of all, you need to be clear with the theoretical side of things before you move on to try to identify these things on the chart, because unless and until you know what you're dealing with, you cannot possibly have a correctly identified phases on live market charts. Now, when we talk about accumulation phases or accumulation schematics, we have five phases, as I said: phase A, B, C, D, and E. So, in simple words, what's happening here is a phase A is the transition from lower low, lower high formation, strongwards. At the very end, you have decreasing volume, failure to make lower lows, and it starts accumulating in a range. Within phase B, where there is failure to break the previous swing low, failure to break the previous swing high of the automatic rally. Then you have phase C, which results in increase in volume and formation of smaller higher high, higher lows within the trading range itself. Then we enter the phase D, where it is again going to retest with a build up higher volume to test the high of the AR or the automatic rally, or in simple words, the high of the trading range that was established in phase B. Then at the very end, you have phase E, which results in a complete breakout of the trend of the trading range or TR that was established in phase B, which results in a complete reversal from the initial lower high of phase A to the new higher high, higher low established in phase E. But again, that is just me explaining. If I put it into the technical terms, then phase A consists of end of the earlier downtrend. Generally, it consists of PS, SC, AR, and ST. Don't worry about the definitions. I'll be taking you through those either. Now, in pre-existing uptrend, now this is a classic example of a role reversal, not role reversal, but a trend shift from downtrend range bound to uptrend. If there is, however, a case wherein the price is already in an uptrend and it halts, goes into a range, and then again breaks the upside, then the schematic that we have here, that is not going to come into play. Then there is going to be a different one which is going to be similar to that of the distribution one. Then we move on to phase B, where you have an establishment of a good strong trading range boundaries, lower swing legs see reduced volume, effort versus result coming into play. Then you have the next phase C, multiple LPSs being formed. Don't worry about what that is, I'll explain that to you. It can be a bit tricky to identify. Most people mistake phase C and phase B together. Then you have phase D, where as a trader you can take long positions at every new higher low that is being formed, with your stop loss going under the secondary test, the last secondary test that has happened, or the last ST. Then you have phase E, which is the break of the entire trading range and the beginning of a new uptrend. Now, if you're one of those people that got worried when they saw these abbreviations PS, AR, SC, ST, LPS, UPS, and all those things, don't worry about it. It's not that hard. I'll be driving you through. Now, if you can, then I would suggest for you guys to, this is where the notebook comes into place, because these abbreviations, you need to note them down. Now, starting with the first one that we have is PS, that is the preliminary support, where you have increased buying volume visible at that swing low, which results in the price later on going on to invalidate the lower high formation. Then the second one that we have, or the closest swing low, becomes the SC, which is the selling climax, or the lowest swing point before which the lower high formation was invalidated. Now, at the SC, you have people who are covering their shorts too. It is going to be the immediate swing low. If that is broken, then this range becomes invalidated. Up move from that point, up move from the selling climax area is going to invalidate the lower high formation. If you are familiar with the structure analysis, well and good. If you are not familiar with the phase analysis, I suggest you guys to check out that video too, and then come back, watch this again. That is going to clarify a lot of things. Then you have the AR, the automatic rally, which is going to be greater than 50% retracement of the previous low swing leg, which happens to be from this swing point above the preliminary support to the selling climax area. It is going to be greater than about 40 to 50%, at least 40% of that entire swing leg. If that is the case, then the lower high formation has been invalidated, because if you compare the relative strength of this sell off to this buyback is stronger. Then you have the ST, which is the secondary test, where the price dips to the SC area, driven by the people who still want that trend to continue. People, retail participants who are not able to identify where the composite man is trying to take things, and they think that the selling pressure is still going to come in, and they take new shorts. Now, there can be multiple STs or multiple secondary tests within the range itself, but every time it is going to dip back to the selling climax region, and it is going to make a strong bounce back, because that selling climax is where the composite man is sitting with his guns loaded, thinking that I don't want this to go down anymore, I think this should go up. So he will be introducing fresh buying pressure every time the price dips to the selling climax area. Now, the failure to make a low swing leg every time it reaches that SC is only going to cement our bias that the range is not going to be broken on the downside. Then you have multiple tests, which is simple, the retail participants trying to push the price back down, but every time being declined by our composite man. Then moving on to the next one, which is the SOS, or the sign of strength, where the price actually has a big increase in volume with a small higher high higher low formation. As you can see from the S3 level, it started and then made higher high higher low formation. Now it often comes after a deep secondary test. As you can see in this case, it tried to break the selling climax area region, but it could not, and that became our next level of support. Now you might have wondered, why did I miss this these two, the LPS. Now these LPSs are nothing but your last point of supports. These are once the phase C has been identified and completed, then you can take a long position at every LPS with your stop loss going at just under your ST or your previous secondary test, or even under the selling climax area region, and then you can continue to ride it on. Then at the very end, you have your BU or build up and then breakout. Now that is where or that is the region from where the price actually builds up volume very aggressively. The composite man has had enough of our retail noise, and he decides to take the prices higher up into the higher low formation, and you have a complete reversal of trend. So that is how it goes. It might seem a bit lengthy, a bit complex, but it is really fruitful. So just to walk you through it again, we start on from the phase A, where we have pre-existing lower high swing leg coming into play. So the recent swing low, or the second swing low from your recent swing low, is becoming your PS or your preliminary support, where you have increased buying volume and or even diminished selling volume, which is also visible through the reduced leg of that particular swing leg, if you are familiar with phase analysis. Then we come on to the SC or selling climax, where the sellers or the big operators or the big sellers, they move out of the picture. They don't want to short sell anymore. That becomes your immediate swing low, and if that as long as that is not invalidated, that means you can be certain that there is going to be a trend change that is going to come out pretty soon. From the selling climax originates the AR or the automatic rally, which is it is only there to invalidate the lower high swing leg. And part of the reason why that happens is because the sellers are not short, the big sellers, they are not shorting anymore. So since they are not shorting anymore, they are booking their positions, they are introducing fresh buying pressure into the markets. And the retail traders, well, they try to short it, but there are counter trend retailers like me who try to ride the corrective swing leg too. Now, because of the dry volume among the sellers, even the counter trend retailers' little volume is able to drive the price up to form a small high until the AR high point or the automatic rally high point. From that point on, the counter trend traders, they start booking their profits, resulting in a small formation of ST, where the trend friendly retailers are thinking that the price is still bearish, they want it to go down again. Now, jitna deep ST or secondary test aayega, it is going to approach the SC or selling climax area, where the composite man is sitting with his guns loaded to enter his buy orders. So every approach to the SC is going to be a place where the composite man is going to be looking at buying in again. Then we enter phase B, where the price is going to be stuck between a range between the selling climax low and the automatic rally high. Either one gets broken, the range gets invalidated. Within that, every dip can be a potential buy point for aggressive long traders. Once you observe small higher high, higher low formations coming into play, then every swing low, recent swing low within that small formation can be called as your LPS or your last point of support, where you can take aggressive long positions with your stop loss going under the previous secondary test or under the selling climax area region. After that, we enter phase D, where we have visible increase in volume on the upside. The price has been making strong higher highs and higher lows. It breaks the automatic rally high point and then enters into the phase E, where you have a clear higher high, higher low formation, and it is observed that the trend has changed completely. So that is how the accumulation schematic works. Typically, you would aim for identification of these phases, particularly phase A, B, C, because phase D may you plan entries and you write it out. So first of all, if you're looking out for accumulation phases, try to find out charts that have been in a pre-existing downtrend for the previous, a couple of weeks or so, because then you can clearly observe whether phase A is going to be forming or not. If you see that the downtrend is coming to an end and it is entering a range, then you can apply these things, try to put into place phase A, B, and C. If they are happening, well and good, you can plan positional entries at phase D and ride out the entire change in trend. Now, let's say you are not able to find charts that have been in a pre-existing downtrend. You only have charts that are in a pre-existing uptrend. Now, even for that, Mr. Wyckoff had an answer. For that, we have the distribution schematic of Wyckoff. Now, here too, just like accumulation, we have 5 phases: A, B, C, D, and E. उसके अंदर we have multiple subcategories, multiple parameters that need to be met. You have PSY, BC, AR, ST, SOW, and LPSY upthrust too. Don't worry about these short forms, but as I said, it would be quite beneficial for you if you are noting down these terms in a notebook, diary, or whatever. Now, coming to the phases, the 5 phases, it's slightly different than what we had on the accumulation side of things. Starting with the first one, you have phase A, which is basically nothing but, for example, if I go back to the accumulation one, you had invalidation of lower low, lower highs. यहाँ पे it's the exact opposite, invalidation of higher highs and higher lows. Typically, phase A includes your PSY, BC, AR, and ST. Then we move on to phase B, which is where you have a clear established trading range, a TR, similar to the one that we had in accumulation 2. But in this case, instead of smaller higher lows, we have smaller lower highs that come into formation. Then you have phase C. Just like accumulation can be tricky to identify, we have multiple LPSYs. It is a bit different from the LPS that we had in accumulation. We'll go to that a bit later. Then you have phase D, which is where you can plan your short entries, or you can exit your pre-placed long entries. If you had ridden the entire uptrend to this point, then this is where you would ideally prefer to exit your long positions. Short entries can be planned at every every lower high that is being formed, and you can ride it out until it has a complete trend change on the downside. Then we move on to phase E, which is break of the trading range on downside, resulting in fresh lower high formations. Now, coming to the deeper technical terms that we have here, such as the PSY, BC, AR, and ST, don't be worried about that. The PSY that we have in this case becomes instead of the PS preliminary support that we had, this becomes the PSY, or the preliminary supply. Instead of the diminishing volume at the swing low, it's the exact opposite. You have the diminishing volume at the swing high. Then you have the BC, or the buying climax, instead of the selling climax in accumulation, because this is the exact opposite. Instead of sellers exiting, you have buyers exiting. Decreased volume at the swing high, biggies offloading, and retailers trying to take it higher but failure to sustain that very swing high. Then we move on to the AR, or the automatic rally. Now, automatic rally pay, the thing is, since the biggies are not there anymore, the volume is not there. They have already almost heavily offloaded their long positions at the buying climax region, resulting in an invalidation of high low formation at the origin of the AR, or automatic rally. At the automatic rally, there are counter trend traders or simple retail participants who think that it is going to go up again. So they want to take it, push it higher, but the thing is they cannot do that by themselves, because they no longer have the support of the good old composite man by their sides. So automatic rally is nothing but a failure to sustain the swing high, or again a lower high that has to be made. It has to be under that buying climax region. If it breaks that, then you cannot apply the phase A origin at that point. Then we move on to the ST. ST is the same as the one that we had, which becomes the secondary test. The price rises near the buying climax area to check the demand supply equilibrium. Then it observes failure to make higher high. Smaller lower high formation starts as we enter the phase B. Then we have the SOW in this case, or the signs of weaknesses, where every time it is entering the low points of the AR, the retail participants are trying to drive it higher, but they cannot do that. Of course, by themselves they cannot. So every time it approaches the buying climax area, it has a sudden and impulsive sell off, which is a strong sign of weakness. Now, a sign of weakness, what that results in is a steep uprise too, because ideally at the origin of the automatic rally, you will also have a good strong demand zone, a good strong support level. So that is going to introduce sudden buying volume into the market, but that won't be sustainable. But that is going to result in a smooth and strong upthrust all the way to the buying climax region. But at that very point, it is going to be failing to sustain that, resulting in it re-entering that range and re-establishing the importance of the phase B, where the price has to stay between the automatic rally point and the buying climax point. Now that becomes the sign of weakness, because that became the origin of the higher high, higher low within the range, but that was quickly invalidated. Then we move on to the LPSYs, or the last point of supplies. The last swing high made after you have a failed upthrust. Every swing high, as long as it is under the buying climax region, every swing high can be a potential short selling point for the composite man and for us too. That is typically when we enter the phase C. If you can observe, you have smaller invalidated higher lows within the phase C itself. Then we move on to phase D, where again it breaks or it tries to break the low of the automatic rally. Then we enter again the sign of weaknesses, but this time it cannot result in a strong upthrust, because the volumes are already not there. The previous buying volumes from the previous upthrust, they were invalidated and they were scared off. But this time there is no upthrust, it breaks it in a smooth, clean manner, and from that point onwards, every rise can be a new short selling entry point. Then you have the UTAD, or the upthrust after distribution, which is not visible here, but that's completely fine. Upthrust after distribution is similar to a fake breakout. Failure to sustain, typically due to low volume, breaks trading range on the downside, which is what happened here, and results in a formation of strong lower high formations, and you have soon transitioned into a downtrend from an earlier uptrend. So these are the two schematics on Wyckoff, accumulation and distribution. Do you want the PDF that I am using to explain? If you do, let me know in the comments below. I'll share it on the Telegram Apex FinServ group, and you can download it from there. Well, these are the important terminologies that you must be aware of. This is the very basic knowledge that you need to actually be able to practice Wyckoff structure analysis for positional swing trading, even intraday trading on smaller time frames. This structure is visible on all time frames, on all trend changes. You just need to be well trained enough, or you need to be acclimated enough with the concept in order for you to be able to justify the kind of time that you'll be spending with it on the charts. But there's always a starting point, so I would suggest that you guys go back to the charts. It is a weekend, you have plenty of time to study the charts. Watch the videos again and again if you have to, and if you have any questions, if you want us to verify your charts, then feel free to drop a text on the Apex back support channel, and we'll be more than happy to check out a couple of charts for you guys. Now next week I'll be coming back with a couple of real-time chart examples on probably indices, if I can find them, or equity too. Now I hope this video is being helpful to you guys. If it is, let me know in the comments below. Don't forget to like, share, subscribe to the channel. Press that bell notification icon too, so that you don't miss the daily upload series or the next week of real-time chart examples. Thank you so much for watching, guys. I hope you are having a good, fantastic weekend with your friends and family. Have a wonderful time. Bye.